We're half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: a muted start for stocks in Asia after strong U.S. factory data reinforces bets for Fed that they won't rush in cutting rates. The yen under pressure with 152 to the dollar in focus now as a potential intervention level.
Chinese assets in focus as the economy shows fresh signs of a recovery, including better than expected PMI readings.
And the property sector, however, remains a drag. Country Garden suspending trading here in Hong Kong after missing a deadline to report results, while China Wanka posts a record profit decline. We're back from a holiday. We're rested, and markets are taking a look at
well, you are. I'm
rested. We're looking a bit rested in markets here right now as well. Of course, we're going to see if there's going to be that catch-up rally in Hong Kong after being off for 2 sessions. But certainly that stronger PMI data that we got out of China lifted the CSI 300 to the highest that we've seen in a month or so. So maybe that's going to help propel Asia higher today. We are seeing stocks mixed overall, but we are punching higher. It's that ISM data out of the U.S., though, that continues to remain strong. That's why you're seeing a bid for the dollar. You're seeing Treasury yields continue to track higher. In fact, we saw a 10 basis point move up when it comes to the U.S. 10-year yield, and we're back to near those 2024 highs across the Treasury yield curve here right now. So certainly we're on intervention watch in the yen because that adds pressure to that currency. You're at 151.70, 152. That sort of is that level, that red line there for Japanese to intervene. They certainly did that back in October of 2022. Will they do that again? Will it be effective? We're still asking those questions here today. And we're watching very closely iron ore as well. We briefly touched a 10-month low. We're basically back off that now on the back of that stronger PMI data out of China. So we're taking a look at that here today. Obviously, we're tracking very closely what goes on with the Nasdaq Golden Dragon. Just given what we saw on the onshore market when Hong Kong was closed, Nasdaq Golden Dragon reacted also in a positive way. We were up close to 2% on Monday. And we're watching very closely what this means for China futures as well, CGBs, dollar China, just given this dollar strength that we've seen as well. But basically, the CSI 300 capped this first quarterly gain in a year. So, are we finally starting to see the data turn more positive? And how sustainable really is this sort of recovery now? That seems to be getting some more traction, Dave.
Yeah, CSI 300, you mentioned that. The next slide in the sand will be, and we're looking at the agenda today. Flip the page, please. We're looking to retest the 200-day moving average on that specific benchmark. And, of course, maybe part and parcel to that is the reopening here in Hong Kong. The Stock Connect, the Stock Connect reopens today, so we'll have a look at flows and what that looks like. Interestingly, in case you missed it, Country Garden said, well, clearly enough, it's already April 2, that it was not going to meet the deadline to submit its 2023 results. It will need a few more days to consolidate more information, account for accounting changes to reflect underlying fundamentals. So that stock is suspended from trade today. Speaking of earnings, Moutai is coming out with earnings later today. And, of course, Yvonne was talking about iron ore. Gold prices hovering near record highs. All that in focus as we approach the open 26 minutes away. There we go.
Yeah, I mean, we missed on this whole blowout number when it comes to PMIs while we were gone, Dave. And Bloomberg Economics has been crunching these numbers and taking a look at what this means. Saying the overall sentiment in China is improving slightly in March, but still no signs of a broad-based recovery taking hold. Let's get to our chief Asia economist, Cheng Xu, joining us now. What do you make of these PMI numbers?
Certainly, it's a very positive report, but you've got to, as you hit earlier, you've got to question the sustainability. And the report itself, if you look beyond the headline, strong headline figures, there are a lot of positive messages coming out of this. The demand and production side both recovered, rose quite strongly, and then the demand coming both from domestic economy as well as external demand. And one thing I find particularly interesting is the small firm PMI rose into expansionary territory for the first time in 1 year. So that's suggesting perhaps the government support measures are working. But there are issues of sustainability, clearly. I mean, we've been here before. Last year, the recovery was pretty strong during spring, but the recovery quickly lost momentum. So we need to watch out for that. I mean, I just came back from a trip to the mainland. The major tourist places I traveled were very quiet, even a couple of days before the major holiday coming up. So that's one side. Another side, we look at the data very clearly. The demand coming back is largely related to production. So the infrastructure spending is up, and related investment and production and services are up, demand. But how this can turn into the ultimate sort of private demand remains to be questioned. That would sustain the recovery over the longer term.
Right. This brings us to the policy question and whether or not the economy, and I think you've already answered that, needs more support. On Thursday, markets rallied quite substantially in China because of this talk about quantitative easing with Chinese characteristics.
Yeah.
You guys have put out a piece on that as well. Are we going into QE? Is that even worth asking as a question?
I doubt we're getting into QE. I think, as we were talking about this earlier, the market sees what it wants to see, and it's hoping for big stimulus. Therefore, the market interpreted President Xi's comment as a signal for QE, and we absolutely don't see that. The comment was within the context of refining the PBOC's toolbox. So we don't see that coming. In terms of policy support, we certainly see this is coming. Fiscal side, strong infrastructure spending, and monetary side, we see for the year as a whole more rate cuts. But potentially the rate cut will be delayed given the quite strong data points and the strong U.S. data, meaning that the Fed is likely to delay its rate cuts.
Yeah.
So in overall terms, we see kind of easing coming, but delayed.
Yeah, it's looking more July or September now. On the Fed. The Fed. Let's go back to PMI. So PMIs were quite strong. What does it tell us about the activity numbers for March that are coming out in the next few weeks?
Yeah, it looks as if the activity data will be stronger than we anticipated as well. I mean, we were projecting weaker numbers for, some sort of rebound, kind of slightly beyond seasonal kind of rebounds, but this is much stronger than we anticipated. So if we look at production, retail sales, investment data for March for the first quarter, it could be stronger than we projected so far.
Okay, Shu Changshu there, Bloomberg Economics on all things PMI, and looking ahead, of course, to the activity numbers coming through, and maybe this market might need a further catalyst, looking at some of the key levels ahead. Michael Liang is with us here, Chief Investment Officer, Foundation Asset Management, Hong Kong. Good morning. Nice to see you.
Good to see you, too.
We're done with the first quarter. How do you think the first quarter went, and how did you guys do?
Well, I think first quarter market did okay, right? We came out a little dip and recovered. Like you said, the PMI number looks good. I think we'll carry on a little bit longer. We did very well in the first quarter, but our focus is probably not on so much on the macro pictures. We tend to look at the differences between the companies.
I think, I was going to ask you, you said, trading on policy impulse is a recipe of losing money.
I'm sorry, it's such a strong word.
Yeah, but so really, we shouldn't be looking at those policy signals, is one thing.
Well, I think the problem with that is, one is, firstly, we don't know the magnitude of policies, and secondly, we don't know how market react to it. Can we really front-run policies? Do we know how market react to each policy come out? My 30-year experience telling me no. So I would prefer focus on fundamentals. If you think the economy continue to be not so strong, not so weak, not so hot, not so cold, I think that it's the best hunting ground for alpha. Okay. That's where the difference between the companies start to show the difference, yeah.
Right. Well, let's talk about fundamentals. We're coming out of earnings season. We're going into first quarter earnings season at some point. How do fundamentals look? Which sectors do you think have the best earnings visibility?
Yeah, absolutely. I think the year-on-year comparison, because of lower base first quarter last year, first quarter this year going to look okay. The thing is how much the investor will interpret that.
Yep.
What market going to react to that? I think I don't know the answer to that. But looking forward to the second half this year, the base is much higher. And also you got a US election coming up. China bashing is the usual easier way in terms of politics. So I think the volatility will come in probably July, August. But for the next 2 or 3 months, I think we're okay.
People have been skeptical about the scope and depth of this earnings recovery, right? When you have big names like BYD, Wuxi that seem to be quite disappointing in some ways. I mean, Are you finding pockets of still, where we're seeing a bit more in terms of earnings recovery than others?
Yeah, like I mentioned during our break earlier, in terms of AI, for example, we talk about AI, the components, the hardware of AI, where China still supply a lot of it, that's doing very well. If you look at the first, the last year numbers and also guidance for this quarter and next quarter, it's very tied to the AI spending and so on and so forth. That's doing very well. But at the same time, on the flip side of it, the application of AI is still early stage. And also, those companies probably tend to trade much higher. They tend to be software companies. They tend to trade a much higher multiples, given the expectations, AI applications. So in that space, even the AI space, we see there are positives and negatives. And the other sector we look at is PC versus smartphones. PC have been in a slump for over 2 years now after the COVID spending, where the US buying a lot of PCs, work from home and so on and so forth. And then after that, people don't change the PC every 3 months, right? Usually the cycle every 2 or 3 years. We come out of the bottom now. It's a cyclical industry. I'm not saying it's going to be organic growth for 10 years, but cyclical. But having said that, smartphones probably far more behind that curve. Right? And also smartphone competition in terms of AI is still kind of unknown. And also in terms of market competition landscape, there are 3 major PC makers in the world. I don't have the names, but I guess you know. But in terms of smartphones, there's just so many. Very saturated competition. So I'm looking at, from our point of view, we'll look at the PC versus smartphone. We'll see alpha there too. Okay.
And just the premise there is PC outperforms smartphones over. Just give us a time frame for that. Next few months?
Oh, we tend to look at it in terms of years, 1 or 2 years.
1 to 2 years.
So you're basically saying this is a market where it's still about tactical opportunities. But even if the data starts to look a little bit better, should I be looking more medium term at how this performance is going to look like in the next maybe 3 to 5 years, more than just kind of what I can talk about the next 3 weeks or months?
Or 3 days?
Yeah.
I think the policy is probably, like you mentioned earlier about QE. I just want to throw in one way to look at that. You see, recently Asia has done very well, but probably got something to do with the weakening yen as well, yuan and yen.
Yeah.
Right? It's my experience in the past with Macau in the 90s. I understand when you have weakening currencies, your local stock market tend to do very well. I mean, remember what happened to Turkey for the last 12 months, right? Right. When the currency went through and then, So this is a backdrop. And then the question is China going to do QE? If they do QE, what's going to happen to the currency? Remember, China has this mega mission is internationalization of renminbi. When you do QE, what happened to the currency? You have weakening currencies. Yeah. Will that serve the purpose of internationalization of renminbi? Probably not. You want a stable currency in that environment. You want more people use it for trades, for reserve, for other purposes. So I think we're in the trading range, if you ask me, in terms of currency, also for the market.
All right, we'll talk more about those currency risks coming up here with Michael Liang, Chief Investment Officer at Foundation Asset Management Hong Kong. Still ahead, we're going to hear why Bloomberg Intelligence thinks Kweichow Moutai may post higher full-year net income despite weaker consumer spending in China. We'll also take a look at what's going on with Xiaomi, indicated about, 15% higher or so in Hong Kong. Of course, we're tracking very closely what goes on with that new EV as well. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. Good morning.
Right, welcome back. You're watching the China Show. We're going into the open. The Hong Kong reopened, so catch up is the name of the game. As it pertains to the reference rate of the day, this is, again, very sizable support here. We're trading at 726. FIX was at 709 and change. That's about 1,400 pips relative to the spread and relative to where we are there. So, I mean, comes down to the Fed, really.
Yeah, why you're seeing pressure on the renminbi, why you're seeing pressure on the yen in particular this morning is really what we saw in the data overnight from the U.S., right? The ISM of manufacturing activity showed expansion for the first time, I believe, in a few months or so. I think the first time in 16 months after being in contraction for some time. So this is the highest reading we've seen since October of 2022. Now, the strong factory data did prompt, of course, what we saw with bond traders to really price in the possibility that maybe that June cut is not as clear-cut as we thought, right? It's not really a base case anymore. In fact, those odds are now below 50%, Dave.
Yeah, in fact, even July is not fully priced at 23 of 25 basis points. If you were pedantic about this, it's really September now that's looking.
Yeah, still with us is Michael Liang, Chief Investment Officer at Foundation Asset Management Hong Kong. Is there now a real risk, Michael, that the Fed's going to abandon 3 cuts this year, what they're projecting in the dots?
Or even no cuts this year?
All right, I mean, I feel it's probably going to be 1 cut. They have to show their hands. And then you get into November election in the U.S. It will be too political to cut, too close to that. So sometime June, July, August, I don't know the FOMC timetables anymore, but I feel like they're going to be 1 cut. And after that, I think they're going to leave it off. Yeah.
Does the delay in the rate cuts also delay the recovery in this general Chinese equity market?
I think this is a pressure. I mean, you have higher U.S. rates. Generally speaking, it's tightening bias. But having said that, you know, we see what the BOJ gonna do. I think a lot of hinted on their movement if they intervene, which I don't think gonna be anything major, because the economy is okay, but not that strong. Yeah. I feel like you're still gonna have weakening currencies in Asia.
Why do you think the yen is so weak? Does it come down to structural, demographics, or is it just more of like a slow adjustment that we're seeing here?
Nothing really changed, right? I mean, if you talk about the demographics, the leveraging, and that's continues, right? The Japanese not getting any younger because the market's, up, doubled. So I think the structural change is going to be with us for a little while longer. But what's driving the Japanese market, I think people kind of miss out. If you look at the 3 component GDPs, right? The most important one driving the Japanese market is capital formation. There's so much investment going to Japan for whatever reasons. Okay, going to Japan, that's driving the GDP. It's probably not so much of a consumption or exports, but capital formation, where China, on the other hand, is kind of a lack of now.
Yeah, well, I want to pivot back to China. Let's say we're 15% up from the bottom. Do you think the bottom's behind us, or is that... so we're in a range. My question is whether or not the worst is over.
If you take a look over 3, 5, or 10-year horizon, I think we're stuck in the trading range for that long.
Wow.
If you look at the Japan's last decade, for example, for reference, it did trade in that range, even in USD terms, not in yen terms, for a long time, and then broke lower. So I think we're probably going to be in the similar situations. That's why I'm saying focus the differences between the companies. It's probably a lot more interesting to trade in and out.
Let me just ask, what's the premise there? Why do you think we'll be in a range here for 10 years?
Well, I mean, it's obvious, right? We have a demographic problem, people aging. I know you got a property leveraging. You just mentioned Country Garden, they're going to pay their coupons on time and release results on time. So this is going to be with us. This will take some time to digest.
Okay. What are we missing? I mean, we feel like we've covered a lot here right now. Is there something that you think the market is underpricing at the moment?
Again, back to the fundamentals, bottom up, we see opportunities.
Yeah.
Right? We're not so much into the banks and properties, but having said that, export-related, AI-related, I mean, even home appliances. I don't know whether you guys are picking up really MIDI, Haier has been doing very well. I mean, 40%, 50% for exports. Yeah. So the global economy doing okay. I mean, those fridges and washing machines is not exactly on the sanction list per se. They're not that sensitive. And Chinese manufacturing power is great.
And there's a whole upgrade cycle and program going on too.
Absolutely, right?
Okay.
You know, they're going for higher, more expensive household products, right? Different brands, you release a different sub-brand. You don't relate to them anymore. You think this is a European brand or something, you know, all of a sudden it's 50% premium.
Yeah, I was going to ask you what brand oven is in the Liang household, but we can save it for the next conversation. It's consumption upgrade is really the peg is Michael Liang up there. Michael Liang, thank you so much. It was great to have you on the show. Chief Investment Officer, the Foundation Asset Management. Speaking of hardware, the big move right now.
Yeah,
in the
we forgot to ask what Michael about EVs and what he thinks about this. Xiaomi joining into the fray here and unveiling their first EV model. We're up some close to 15% in the pre-market here in Hong Kong. How many were the pre-orders?
500,000.
Wow.
Was the initial one. And this came out, I think, a few days back. So certainly the market's digest. And of course, we're reopening, right? First time we're getting a jab here, as far as that's concerned. All right, the open is about 6 minutes away. Full preview just ahead. This is Bloomberg. Good morning. Okay, welcome back. You're watching the China show. Why not? There we go. 4 minutes to the opening bell. Futures are doing this. We're looking at, I guess, one part earnings. Kweichow Moutai is coming out onshore, and of course, this big number coming out of Xiaomi, which is one of your bigger movers, of course, in the pre-markets right now. Yeah,
it's surging here on the back of them unveiling this SU7 series with a price tag of just under $30,000 US. So certainly that's helped lifting the moods here of the likes of Xiaomi. In terms of analyst actions, Agbank 8 shares raised to overweight at JP Morgan. China Overseas Land raised to a buy at CLSA. We also have Ganfang Lithium A shares cut to a sell at Goldman.
Yep, a couple of stocks to watch there, as Yvonne is pointing out. And by the way, just to correct myself, my mistake, and give us a break, we're just coming out of a long holiday here. Xiaomi, not 500,000, 90,000. There we go. Anyway, plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down the open of markets here, and we're seeing a pretty uplifting catch-up story coming through here in Hong Kong after being shut for 2 days for the Easter holiday. So playing a bit of catch-up here, of course, on that stronger PMI data that we got for March. You got to wonder whether this sort of recovery lasts once again, Dave.
That's an interesting juxtaposition because ISM in the U.S., of course, also coming in to Yvonne's point earlier on expansion for the first time in many months, right? So that's basically a dollar EMA FX story, if you will, dollar-yen story, which we're also going to unpack. 9 seconds to the open. So the initial one will be a pop at the open, as Yvonne is pointing out, because of some catch-up here. It's also going to be a very strange week because Thursday and Friday, mainland China is then shut. Hong Kong is shut only on Thursday, comes back on Friday. To the better part of a lot of you that have seen this holiday coming and just took the whole week off, kudos on you. Thank you for joining us from the bar, from the beach, or half asleep from your bed. Looking at the open, 2.7% to the upside. Hang Seng the tech index, or 10-year yield, still pushing or hovering at these 2.3% levels. Dollar China, quite a sizable fix. In fact, it was the biggest spread, biggest anchoring, biggest support from the PBOC going back to October of last year, 1,400 points. Almost takes you back to those record levels that we had back in early of Q4 last year. Movers to tell you about earnings is a big story. Mautai's up at the very top here. It comes out with earnings later today. The guidance out of the company was 15%. Do we get slightly more than that? We'll do a preview of Moutai in just a moment here. Some changes as far as ratings go. Goldman's out Ganfeng. Lithium, in fact, a contrarian call coming through out of CLSA, bottom of your screens. Van Kos said, well, record drop in profits coming through there as well. But keep in mind, of course, Country Garden was supposed to be one of the stocks we're tracking today, but because they missed that deadline to submit their earnings, which is the end of March, they've now suspended shares, or shares are suspended on the back of that. Citi adding Trip.com. There we go. 90-day upside catalyst on Trip.com. We're up 7% in the early goings. Might have to do with this next page, all the data coming through as well. During this long holiday, Macau casinos in focus, this visitor conversations coming through as well, and flows of tourists coming through in Macau. 50% up as far as gross gaming revenue for March was concerned. March, I believe. Yes, there we go. 2.8%. Xiaomi, we talked about, is 90,000 in the first 24 hours of that new EV play. BYD's up 2.5%. March deliveries, by the way, data was out, so investors are digesting that. And of course, we have to talk about gold prices with Zijin Mining here, and also Zhaojin Mining also leading those gains. Very, very quickly, the 1% pop or so we had yesterday on the CSI 300 now means bulls have another opportunity to test and retest this 200-day moving average, which, by the way, we have yet to breach all the way back, going back all the way back to the summer of last year. Momentum has certainly held up quite well. Hasn't been enough, Yvonne, to take us through that key level, which, as things stand, is now 36.10. We're trading at 35.93. That's about a 20-point gap from where you sort of want to be. We'll see what happens today.
It's largely been sort of a resistance level more than anything, right? Let's bring in our stocks reporter for Asia, John Cheng, joining us to talk a little bit more about what, the momentum, as David mentioned, John, in this equity market now as we wrap up the first quarter. I mean, what does the second quarter, what's in store now? Are we likely to see this rally kick in and gain more traction?
Definitely today we are seeing that positive momentum from the CSI 300 carrying through to the Hong Kong market after it reopens from holiday. The macro picture is indeed showing some signs of stabilization. The positive PMI data and also positive export figures, inflation data, these are all suggesting that possibly in terms of the macro front, the worst is probably over for China. But if we take a closer look at earnings, it's pretty much a mixed bag because all the big banks and also property developers, their earnings are less than desirable, although there are also some green shoots in earnings in terms of the tech sector. So from the earnings side, it's pretty much still a mixed picture. So I think possibly going forward, we're still looking at pretty much a range-bound scenario for Chinese stocks.
Okay, well, let's take a step back then, because you put out this piece, and really this theme goes into what we saw last year: buy the winner, buy India, buy Japan, sell China. This rotation, is that gaining traction now in the reverse order here among investors, John?
So India was one of the biggest EM darlings for investors last year because of the need to diversify away from China. And that also applies to Japan and also some tech-heavy markets like Korea and Taiwan. But this year, indeed, we are seeing a bit of a reversal of that starting to take place. One thing is because India valuations have become so expensive, it has always been an overhang for investors. But given that, relatively speaking, China has become so cheap, if we look at the likes of Tencent, Alibaba, they're trading at even lower valuations than some utility stocks. And that, to some investors, has become indeed very attractive. So just from a valuation perspective, the trade has a bit of reversal. And also in terms of, like I mentioned, in the macro picture, China is indeed stabilizing a little bit. And we've seen increasing support from regulators to boost the economy, boost the market. And that has indeed given some investors the confidence of piling back into the Chinese market.
Okay, and what does that tell you about the outlook then for India in particular? You talked a little bit more about China, but really what's the outlook for stocks now in those two markets?
I think India, we're seeing the stock rally has sort of taken a breather. It's been pretty much range-bound for the past month or so. I think one thing is valuation has really become alarming. And secondly, regulators there have also came out and warned against some market froth. And we also saw the small cap stocks crashing earlier on. So, there's indeed a little bit of caution there. But I think most investors are still seeing this reversal of India-China rotation as more of a tactical play, especially when Prime Minister Modi is expected to get his third term in the election later this month. So there's a bit of policy continuity there, and long-term growth outlook for India is still pretty much solid. And on the other hand, like I mentioned, there's still a lot of headwinds facing the Chinese market. So some people might be still opting for more of a wait-and-see attitude when it comes to China.
John, thank you so much. John Cheng there, our Asia stocks reporter in Singapore for us. About 7 minutes, going into 7 minutes into the session right now. CSI 300 flat. Gap higher across most of these Hong Kong benchmarks. We'll have, since the opens, sort of pared back some of these earlier gains. Although on the HS Tech Index, as we can see, we're about 2.2%. Most stocks are high, with the exception of a few names like XPeng, for example. Lenovo and NIO are sort of moving against the grain, but EVs are playing massive catch-up in this Hong Kong market. Plenty more ahead. This is Bloomberg.
All right, one stock in particular watching out for here today is not just Xiaomi, but really Kweichow Moutai. We're still talking about the consumption play here, where 2023 earnings are due out later on today. Bloomberg Intelligence is seeing the liquor distiller posting 17% profit and revenue growth year on year. Let's get more now from our senior analyst, Ada Lee. So 17%, what's driving that?
Correct. So we're looking for 17% growth in sales, which is actually ahead of what management is expecting. They are looking for, they were looking for 15% target for this year, but we do believe that they will exceed that to 17%. And then as a result, the earnings per share will also grow by 17%. This is actually quite a robust set of expectation. And, you know, if you look at current condition in China, the consumer confidence is quite depressed. But we are still expecting robust demand because everyone loves the brand.
Yeah, in good and bad times.
In good and bad times, you still drink to that.
Yeah, there's a reason. There's a reason to bottoms up. Talk to us about core brands
Right.
and the new ones that are coming up, because core brands still, I believe, makes up the vast majority of revenue, but there's a fast-growing segment, of course.
Correct. So in terms of the core brands, we all know about the Kweichow Moutai, which is, you know, where everyone love and continue to purchase, and that's where it holds value as well for the consumer as well as investors who invest in physical stocks. So those are the key drivers for the company's sales, and we're also looking for about 17% growth in that. In terms of the new product, it is up and coming, but it remains a small segment at the moment. And those are such as, you know, like the cafe latte, the chocolate, I think there's even more sparkling wines, mixes for cocktails. You
Ice
name
cream,
it.
right? I've seen Moutai ice cream too made before.
How did that taste?
I don't know.
Yeah.
Pretty good.
Well, I guess, you know, at the end of the meal, if you're caught up between dessert,
Why not?
or you know, I don't know, a Chinese port, I don't know. Have both.
It's still expensive though for dessert. I think it's about 60 to 70 yuan per cup. So it is actually quite expensive in terms of, you know, in Chinese standard.
Right.
And Chinese, I think in terms of ice cream market in China is under a bit of pressure at the moment. So
You cover ice cream too,
I
Ada.
cover ice cream too, correct. So I cover all the happiness in China.
And ice cream, I love it.
Sweet or bad for the liver.
Yeah.
Is there a risk to this company? I think, you know, we always talk about this company as having 15% growth, 90% margins. Demand's always there.
Resilient.
Is there something wrong, or is there something to watch out for?
I think there's something to watch out for. In terms of what I'm watching out for in this set of results, is the key driver is the direct to consumer. How much is that contributing to the total sales of the company?
Okay.
So in 2022, it contributes about 45%. By first half of 2023, it actually jumped to 45% already. Why is this important? Is that based on our calculation, when you look at per bottle of Kweichow Moutai, if they sell it direct to consumer, the gross profit can actually increase by about 40%.
Oh, wow.
So it can drive the gross margin substantially if they push more sales to direct to consumer directly. But of course, some people then ask, well, why don't they just push them all to that? But you don't want to upset the distributor as well, right? You need to maintain that balance between distributors, who's also making a lot of money downstream and, of course, helping the economy, as well as, you know, balancing the gross margin. So we are also looking for some gross margin expansion opportunity going forward in the next few years. But how much is it going to grow? Well, we're not seeing a massive gross margin expansion because it's already at 92%. It's a little bit tricky to grow by 10%. Let's put it that way. So I do expect some gross margin expansion, but maybe more gradual step, more slow release of gross margin as they go more into the direct-to-consumer. In terms of what to watch out, like you said, the risk. I think when you look at the consumption downgrade, you know, in China as well as in the consumer side, it is actually quite tricky at the moment, right? Consumer confidence is almost at all-time low, although we have seen an uptick in recent months, but it's still very low when you compare to historical level.
Do we know what the percentage of the core brand is direct to consumer and not through distributor?
Yeah.
Well, unfortunately, the data is not really available in that. Yeah, they don't really break it down to that level.
Okay.
They only break it down to how much of the total sale is to those. Yeah.
Okay, but I guess we could tell when they come out with the margin. We could deduce it from that. There we go. Ada, thank you so much. Ada Lee there, Bloomberg Intelligence Senior Analyst, Liquor and Ice Cream. There we go. Learn something new every day. By the way, we'll talk more about Moutai earnings coming through later today. Morningstar Senior Equity Analyst Jennifer Song also covers the stock. She'll be joining us in the next hour of the China Show.
Ice cream is always good in every season's good for me. All right, take a look at comes to FX side of things, though. The dollar's getting more sweet, I guess you could say, right? Take a look at where we see with FX, 150, 173. We're still on intervention watch for yen. Even if we do see intervention, though, people are saying, look, maybe it's a 5 yen sort of impact more than anything. We're watching very closely the renminbi as well. You know, despite the strong fixings from the PBOC, we're still talking about a dollar China 7.25, 7.26 levels here this morning, and 107 for euro dollar. We're talking more about the RBA as well, set to switch to a new framework for the implementation of monetary policy. The Assistant Governor for Financial Markets, Christopher Kent, outlined those changes in a speech at Bloomberg's Sydney office. And afterwards, we asked how the moves will help the central bank streamline its operations.
What we've announced today is a new system for implementing monetary policy, what we'll be transitioning to in the future. But I wanted to emphasise that really is about the plumbing, the nuts and bolts of moving money around, about us achieving our cash rate close to the cash rate target, but it's not what that target is. What that target is monetary policy. This isn't about monetary policy, it's just how we achieve the target at any given time.
But it's also about responding to perhaps some of the imbalances within the system structurally coming from the last few years.
Well, it's about responding to the running down of the very large level of reserves. We call that excess reserves that are in the system, because we and other central banks pursued unconventional monetary policy. So they put a lot of money in the bank's accounts. Those are gradually unwinding as our bonds mature, as the TFF gets repaid. So it's about looking to the future and thinking about how, what we need to do to sort of what system we need to transition to.
When it comes to the moderation of that balance sheet, obviously a lot of it will depend on underlying demand, but do you have sort of an idea of scale, of timing, of how that framework will play out?
No, we don't, and indeed that's partly why we picked the system we've picked. So what we've chosen is what we call a full allotment allocation system at our OMOs. That means the banks come to us and for a fixed price they can borrow reserves, pledge collateral for 28 days at the moment, and they can take what they want as long as they have sufficient collateral. So what that means is the supply of reserves is going to depend on the bank's demand. The banks have their own estimates. We could come up with some rough ones, but until we get there we won't know. But it should transition fairly seamlessly from one of excess to ample, and we'll know we're there when banks start showing up in larger numbers and larger quantities at our operations on a weekly basis.
I think until we get there we won't know, probably, you know, is a good phrase to describe a lot of aspects of where we're at the moment in terms of monetary policy. Upstairs you were asked, you know, a little bit cheekily to give one word to describe monetary policy settings and trajectory. I'm going to give you a few more words if you want. Can you elaborate?
Yeah, I think the starting point is just to say that the board's made it clear it thinks the interest rate path that will best bring inflation down in a timely manner is uncertain. And so they've not wanted to rule anything in or out with regards to interest rate changes. We're in a better place than we had been. Inflation's come down a long way. It does look to be moderating, but the path, according to our forecasts, is a gradual moderation from here. Labour market pressures, they're easing. They're still tight, but they're easing, and that's because growth's slowing, and so that brings demand into a better balance with supply. So all those things are in place. Our central forecasts are sort of predicated on sort of further good things happening, including productivity growth, but there's a lot of uncertainties around that. And I think the key point is those are reasonably well balanced as best we can tell, and because of that, the path's uncertain. The next rate change Don't know if it's higher. Don't know if it's going to be a lower interest rate.
When you talk about the the inability to rule out shocks, right? How much of those risks do you worry about that might be external, that might be geopolitical, that might be election-driven, the policies of other countries, and how much of it are sort of domestic, maybe structural, macroeconomic aspects that perhaps we haven't seen in the data sets yet?
I think it could be both. We just don't know. But I mean, as a small open economy, we're always subject to developments offshore. We've talked quite at length about what's happening in China. China's a major export market for us, and there are concerns there about their property sector and the problems that they're trying to deal with there. So that can have an impact on things like the demand for our key commodities like iron ore, and that can move our economy around. But equally, domestically, things can be moved by what people here in the Australian economy are doing, particularly households at the moment. How are they going to behave in the future? That will sort of be a key point for where the economy goes.
Christopher Kent, Assistant Governor at the RBA, speaking with Heidi earlier on shows. Right, plenty more ahead. A lot of big movers to tell you about in this Chinese market as Hong Kong markets reopen. Benchmarks looking like this. So, yeah, we'll leave you with a little bit of a tease there. This is Bloomberg. As promised, you have a whole gamut of big stock movers. Thank you so much. Nice pan, by the way. Kudos to our directors right now. There we go. Xiaomi up 15% earlier on. We're paring back a little bit. 12% now. Markets embracing early signs of an EV success story still. So the company said it received orders of nearly 90,000 units within the first day. For its first bets foray into the EV space. In fact, let's get more on the story. Our global business editor, Peter Verco, is with us right now to tell us about this. And certainly, Peter, by the way, we'll talk about Tesla in a moment, but certainly this sets the stage, really, of what's still a very hot market, despite, of course, the price wars taking place. Talk to us about the Xiaomi story today.
Yeah, as you said in the introduction, phenomenal interest in this new EV, with the company saying that it received orders for almost 90,000 of the cars in the first 24 hours since it was launched. One of the big selling points here is clearly just price. It's very sharply priced. The entry-level model is coming in at the equivalent of around $30,000 US. That compares to around $50,000 US in China for Tesla's Model Y. So, I think that's one of the reasons that there's a lot of interest in this car. The Xiaomi name as well, just helps.
Sure, and whether they can deliver. It's interesting, though, you mentioned about Tesla. It seems like analysts are not too optimistic about how sales are going to turn out. What are the reasons behind that?
Yeah, well, Tesla is due to report first quarter sales tomorrow in the US. The latest estimates that we have there is it's going to come in at around 449,080. That would be a 7% decline from Tesla's record sales in the fourth quarter of last year. And what we're really seeing is that Tesla's just being caught up in what is a broader slowdown in the global EV market at the moment. And being a pure EV maker, it doesn't have other models to fall back on in the way, say, GM or Toyota does. And just in the last few weeks, we've seen Ford slash the price of its Mustang Mach-E in the US. Fisker's cutting the price of its Ocean SUV. Apple abandoned its EV project. Though, there's a lot more at play there than what's going on. So it just looks like that EV boom that we saw in the last couple of years has peaked for now. Still, it's not all doom and gloom. Bloomberg NEF is still forecasting that globally EV sales will rise about 22% this year, albeit that's down from 30% growth last year. And a lot of that growth is coming in China, which is a really competitive market, particularly for Tesla.
All right, Peter, thank you, Peter Verco there. And let's check on the markets beyond just a Xiaomi story, but lots of movers, as Dave mentioned here, when it comes to Brilliance staying in the auto space. Earnings coming out last week, and we're seeing that catch up there. We're up close to 30% for this stock after they did beat when it comes to earnings. We're seeing upgrades from BOC, from Daiwa here, China Wanka, record profit decline, Trip.com, Citi, putting it on a catalyst watch on stock.
Yep, just ahead, more on these markets. More on the Fed, really. StashAway joins us in a couple of minutes. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300 now just a half hour into the session here. And certainly, obviously, we saw the biggest move in a month yesterday on the back of stronger data. Where you're seeing a lot of that price action here today, Dave. It really is where we are here in Hong Kong. After just a few good days of vacation, that's all it takes, really.
Yeah,
come back in a pretty good
everyone
mood.
Needs a long weekend, right? And by the way, us included. And you know, if you haven't noticed, Yvonne and myself, we're both kind of glowing this morning. Really on the back of that long weekend. Which, by the way, and speaking of a weird week ahead, right? So we're coming off a long weekend. Hong Kong is actually shut again on Thursday. China shut from Thursday and Friday. So it's one of those weeks where it's truncated in some ways, and of course you don't have to stock connect. In any case, of course, just to build on Yvonne's point, there is a catch-up element. So gap higher at the open on the Hang Seng Index. This is just really a representation of what else is happening here in Hong Kong. And guess what? 17,000 is yet again in play, and we haven't been at 17,000, I believe. We've been range-bound for the better part of this year, really, apart from, of course, that initial rally. And it's 17,000, one to watch. On the CSI 300, 200-day moving average was the one in focus there, 2.5% to the upside here today. The rest of the region, though, range-bound, muted, volumes are quite low. You are getting a stronger dollar story, which is certainly what we woke up to in the Asia-Pacific early this morning with your two-year yield back at 2.7%. So we're near year-to-date highs, again, just about across the curve. Comments out of Jay Powell, no rush to cut rates. These strong ISM numbers back into expansionary territory for the first time this year. U.S. numbers, by the way, they're so sending the dollar higher, which is why we are still on intervention watch as it pertains to dollar-yen. So we did get very close a few days back to 152, and then sort of the first strong sign of verbal intervention happened and sent us back towards the low 151s. We're back inching closer to 152. So we'll watch it very, very closely. Bloomberg Dollar Index. And iron ore is seeing a bit of a bounce today after we hit 10-month lows in that one as well. And Brent crude, just to mention that. And also gold. So that's a 5-month high. Gold separately is trading near record high. So we'll unpack all of those market stories, of course, later on, Yvonne.
Yeah, you got to wonder, have we really reached the highs of the Treasury yields, for one thing? You know, have we run the course on this correction? And then you got to wonder, you know, what is gold telling us here? That we're still around those record highs. On the flip side of that, that's really just adding more pressure to the likes of the yen, right? Where we've heard from Suzuki-san, the finance minister, you know, talking about these excessive volatility that they're seeing is unwarranted and the like, which brings us a lot of discussions of whether we are going to see some intervention of the currency. Let's bring in Stephanie Leung, Chief Investment Officer at Digital Wealth Management, StashAway, joining us. Let's talk about China first, just given what a catch-up rally that we're seeing here in Hong Kong. The macro backdrop seems to be turning a little bit more positive. Does that mean the equity market can continue to rally?
Yeah, I mean, that's the number one question that I've been getting from investors is, I mean, is China investable? Is it time to get into China, or what should they do with their China holdings? I think if you look at China, like we've been saying in the past 2 years, that China has been going through both a structural and a cyclical kind of downturn. We're seeing some positive developments for the cyclical part of the economy. I think if you look at, for example, the latest PMI number, it is above 50, meaning that the economy is actually back in expansion. Now, this is after kind of a year and a half of really, I mean, slumping in the manufacturing side. On the other hand, also, if you look at inflation, I mean, what we've been seeing is that China has been having a deflation problem. If you look at CPI has actually been turning positive again as well for the first time in a number of months. So it seems like China's cyclical story is actually turning better. And if you kind of zoom out to global manufacturing data, what we're seeing is also that global manufacturing cycle seems to be turning high as well. Yeah. So, of course, that is quite positive for China, given that China economy still depends largely on exports. So even though there are still structural problems with China, namely, of course, the property sector, I think from a cyclical perspective, I mean, there are positive signs. And I think from a positioning point of view, look at kind of where investors are positioned. I mean, China is actually one of the most under-owned equity market globally. So there's definitely a bit of catch-up trade to do.
Okay, well, so what do I buy is the simple question. What do I buy in China?
The cyclical, yeah.
Yes. I mean, still you want to be buying growth in China.
Okay.
Like in terms of where growth is, of course, the higher tech sectors are still very, very cheap compared to its U.S. counterparts. I think also from a cyclical perspective, the financials could do quite well in a cyclical upturn. Manufacturing, commodities is also very interesting. You look at kind of what sectors are leading in the Chinese equity market is the oil companies, right? Is these kind of more cyclical companies. So I think if you look at oil prices are also quietly moving higher. That kind of corresponds to what we're saying about the global manufacturing cycle kind of making a comeback. So I mean, those sectors could be quite interesting in China.
Your take on earnings so far?
Yeah, I mean, earnings is always kind of a lagging indicator, right? I mean, earnings will show kind of in maybe a quarter or 2 quarters. So if you look at current earnings, you may not see a lot of changes. But if you look at some of the leading indicators, which, I mean, we do, these leading indicators is telling us that, I mean, China's probably has already seen its worst in this kind of cyclical earnings downturn.
I want to ask you about the Fed part of the conversation. The two-part question is, do you think U.S. equities or global equities can continue the momentum if the Fed eventually does not end up cutting rates? That's number one. And why do you think U.S. markets have yet to adjust lower as we push back the timing on the rate cut, potential rate cut?
Yes. I think what we've been saying for a few months is that the market has been very optimistic or kind of arguably too aggressive in their kind of interest rate expectations for the Fed. At the beginning of the year, the market was expecting kind of 5 to 6 cuts this year, beginning in March. Now, of course, today we're at the beginning of April, and the market is now saying that the Fed will start cutting the first time only in July. We think that actually, I mean, that is actually very, very close to what the Fed's telling us in their dot plot. So I think if you look at where interest rates are now, real interest rates, meaning if you take the nominal rate, deduct the kind of inflation rate from it, the Fed is actually running about 2% real interest rates, which is, I mean, in their mind, quite restrictive. So I do think that the Fed will try its best to kind of push through the 3 interest rate cuts that it has promised the market. Now, of course, if inflation starts to inflect higher again, I mean, that puts the whole thing into question. But I think given kind of inflation where it is right now, 3 to 4%, I think that's kind of quite sustainable in the short term. Now, of course, the bigger question is, when will the Fed get 2%, right? Because 2% is the ultimate target. And are they going to get there? And I think a very interesting development in the market, which is the gold breakout in March, is telling us the market is sniffing out something. The market is actually sniffing out that perhaps the longer-term inflation rate is not going to be at 2%. It's going to be higher, above 2%. And I think from some of the Fed kind of communication, that may be the direction that they're heading as well. I mean, they're actually going to be quite comfortable, even if inflation rate is not at 2%.
So if that means, I mean, there's still an inflation hedge when it comes to the gold play, is the dollar going to stay pretty much elevated until they actually cut, presumably June or whenever?
Yes.
And what does this mean for overall EM assets?
Yeah. I think when you talk about the dollar, you have to think about, is it dollar versus gold? Is it dollar versus EM, dollar versus yen?
Yeah.
I think during 2022, or kind of during the whole kind of Fed hike cycle, dollar was the dominant factor, right? Because the U.S. was the driving force. The Fed's increase in interest rate was so drastic that, I mean, it attracted a lot of capital into the U.S. system because, I mean, you're getting 5% interest rates. Therefore, I mean, the U.S. dollar was unanimously strong versus like every other currencies. I think going forward, you see kind of a divergence. It depends much more on individual central banks' kind of policy. For example, I mean, Japanese yen is still fairly weak because if we look at the Japanese central bank, they're still printing money, right? They're still keeping a very, very loose monetary policy, even though they're saying, actually, we're making a change in our interest rate policy, but it's compared to the Fed, it's still, there's a wide gap. Now, if you look at gold, for example, I think if you think about kind of long-term fundamental value of gold, it's basically a currency. It doesn't earn you any income. So versus US dollar is basically the cost of owning gold is the real income that you get from US dollar. And if you look kind of over the next decade, the problem with the US dollar is that the US government will be printing a lot of money or have to raise a lot of debt to fund its deficits. So the market is telling you that basically the dollar may depreciate further because there will be high inflation pressures because, I mean, basically the government has to fund all the spending. And most of the spending is actually, apart from kind of mandatory spending on social wealth, social kind of security and healthcare, a lot of that goes into interest rate expenses. So I think basically that means, can the Fed increase interest rates dramatically to fight inflation? Not necessarily, because they need to keep the interest rate low.
They'll punch their peers at the Treasury.
Exactly.
Well, as you're speaking, right, fittingly enough, just an example, right, dollar Indonesia, dollar rupee actually fell to the lowest, weakest level here since 2020. So when they look at, say, dollar fixed income, dollar paper, for example, this year has been it hasn't really gone well on price for Treasuries, investment grade. High yield isn't very, very well. What's your advice as far as exposure to fixed income?
Yes. I think, I mean, of course, a traditional portfolio has a 60-40 or a mix of equities and bonds. And bonds have done very, very well in the last 30 years because of a persistent kind of downtrend in interest rates. Now, the question is, going forward, can that kind of persistent downtrend persist in the next decade or so? I think there's a question mark there that the market is suggesting, given the kind of government deficit that these U.S. Treasuries will have to fund. So if you think about the numbers, CBO itself, I mean, U.S. government itself is projecting kind of government deficit to stay around 6% and increasing to about 8% by the year 2050. So over the next 30 years, you will see this persistent kind of deficit putting some pressure on the U.S. Treasuries. And I think that puts a lot of question into, like, can you still own Treasuries like what you've done in the past 30 years?
Okay, well, we'll try and build on that answer. Stephanie Leung stays with us from StashAway. Just ahead here in the China show, we're talking earnings with Morningstar. They're coming on, of course, to talk us through what. So we have casinos coming out, good set of numbers. As far as Macau is concerned, Moutai is coming out later today. So Jennifer Song actually covers both areas. She'll be talking about that later. And, of course, also coming up is what's been taking place in terms of dollar-yen as we approach, again, potential intervention levels there on the currency. Plenty more ahead. This is Bloomberg.
The report that came out this morning is pretty much in line with our expectations. We're making progress. This is good, but we need to see more. The decision to begin to reduce rates is a very, very important one. The economy is strong. We see very strong growth. We had growth for last year over 3%. We don't need to be in a hurry to cut. It means we can wait and become more confident. I don't think rates will go back down to the very, very low levels they were at before the pandemic. This economy doesn't feel like it's suffering.
There we go. Fed Chair Jay Powell discussing recent data and also the outlook on rates, and certainly what happens in one part of the world is being felt immediately just across the Pacific. Dollar-yen approaching, we're at a high 151s right now. So I guess markets learned their lesson. Did they? Are they about to learn another lesson here? So as we try and grab 152, they got their hands slapped last week out of Japan. Is that the same lesson we can go into this week? Let's bring in Paul Jackson, our Japan Economy and Government editor. Paul, what levels are we looking at right now in terms of potential intervention here?
Well, we get back to this point about whether they are targeting levels, drawing lines in the sand, or whether it's about the movement. I think last week they managed to project the impression that 152 is a line in the sand and they're willing to protect that. However, the problem is we've been kind of in the ballpark of 152 for quite a few days now, so it becomes more difficult to justify intervening at a level like 152 at this point, because Japan would have to explain to its international allies why it's moved, and international agreements suggest that markets should determine exchange rates, and there's got to be excessive moves excessive volatility that governments act against. So defending 152 is going to be a little bit difficult to explain at this point a week later. So perhaps the more plausible scenario is if we get through 152, there's a bit of a surge, and then Japan moves in after that. Now, what could be the catalyst for that? Well, I think as we saw with the overnight US data, the ISM, showing again extraordinary strength in the US economy, if we see, and that's nudged the yen weaker, if we see a blowout jobs report on Friday, I think we could be in for an exciting Friday evening. And don't forget that in October 2022, Japan did intervene late Friday night.
There goes our weekends then, Paul, right? Yeah, interesting, right? So we have the jolts Tuesday, we have jobless claims, and we have the jobs report on Friday. So plenty of data to really chew on for the next few days. What impact do you think intervention could have this time around? Could it have more of a lasting effect?
You know, the point here is, I think, you know, we're looking at this overall interest rate scenario of the Fed eventually cutting. Obviously, it's kind of been pushed back, the expectations of when that's going to happen. June, which seemed like, you know, a slam dunk previously, is now, you know, not quite so sure. Could be later July, maybe even September. So the sooner the Fed gets on with cutting, the sooner the dynamics in the market are likely to change. But the Fed is not going to be raising interest rates. So when you look at it, we are really close to the kind of medium-term limit of how weak the yen could go. And I think policymakers in Japan are aware of that. They're not, like in 2022, worried if they were staring over the abyss. It's more like they know they're kind of near the end, and they're just holding the breath and crossing the fingers that they don't have to intervene this time. But as I say, if we go past 152, get a bit of a surge, I think they would move in. They'd be looking to move the yen by at least 4 yen against the dollar. Otherwise, the move would be looked to be a failure. But of course, it won't hold those moves. We'll soon be back within probably 1 yen of where we were before within the week.
All right, Paul. Thank you, Paul Jackson, a Japan economy and government editor, joining us out of Tokyo. We're back with Stephanie Leung, Chief Investment Officer at StashAway. Yeah, I mean, people could argue that this equity market in Japan is benefiting from a weaker yen. I mean, can that continue, these two dynamics, you think?
Yes, I mean, if you look historically, of course, the weaker yen actually benefits the equity market in Japan. And I mean, this time it's not very different, right? You've had a very, very big move in the yen. And I think this time what is different is perhaps that if you think about Japan, it has gone through a 30-year deflation period. And with the Nikkei actually surpassing its peak in the 1980s, what the market is signaling is perhaps, I mean, Japan is really getting out of deflation. And that seems to be what the BOJ actually officials are kind of believing as well. That's why, I mean, they had the kind of confidence to move interest rates to positive. Now, of course, if you think about the BOJ, I mean, they have been focused on fighting deflation for the past 30 years. So a lot of thinking at the bank, at the central bank, is actually very, very much ingrained in being kind of, I guess, more inclined to be looser than tighter, because they never really had to tighten policies, right? They really didn't have to fight inflation. So I think still, they would be a lot more cautious at the beginning of this kind of nascent inflation, I guess, environment that they're getting into, which explains, I mean, why the yen could, I mean, still remain quite weak versus the U.S. Particularly now that, I mean, we're seeing actually the manufacturing cycle in the U.S. recovering. That just adds fuel to the fire. So I do think that, I mean, from a structural perspective, we think actually the Japanese economy being able to get out of deflation is a kind of a 3-decade long in the making. So it has kind of still a number of years to run if that really materializes. from a cyclical perspective as well, right? I think globally, if manufacturing cycle comes back, that benefits like Japanese economy to a greater extent, given that it's quite industrial based. And then secondly, a weaker yen definitely benefits the economy as well. So like it seems like all the stars are aligned. Of course, the positioning in the Japanese equity has been going higher, but it's not yet at excessive levels.
Okay.
So I think if you look at kind of where investors are positioned in Japanese equities within a global portfolio, it's still not at very, very extreme levels.
You mentioned something interesting there, that the relationship between, the yen weakens, the stock market does well. Let me just challenge that. Do you think, the end of deflation changes that relationship? Because deflation forced Japanese corporates to look for growth elsewhere.
Yes.
Right? So weak yen, you had those earnings coming in, which were boosted by the weak yen. And do you think now that, things are looking inward in Japan, that relationship might not be the relationship we're used to
Yes.
moving forward?
Yeah, I think if you kind of think about an export-driven economy versus a domestically driven economy, now export-driven economies like kind of weaker currencies. And I think still largely Japan is an export-driven economy, right? A lot of the resurgence in economic activity comes from stronger exports in terms of tourism. Like we're all kind of going to Japan to spend because the yen is so much cheaper. I still think, it'll take some time for Japanese domestic economy to become the bigger driver. I think perhaps one of the biggest hindrance is Japan's aging population, where you don't have a young population. You restrain as to how much domestic consumption can drive economy. So I think at least in the short to medium term, still Japanese yen or Japan economy is driven by kind of exports, stronger exports.
Stephanie, great to see you.
Thank you.
Have a great truncated week ahead.
Thank you.
Stephanie Leung, Chief Investment Officer at StashAway. Right, lots of stock movers to tell you about on the other side of the spread. Stay with us. This is Bloomberg. Right, welcome back. We're looking at Japanese semiconductor stocks, certainly on the back of this decent amount that the Japanese government is putting in here, really on the back of just trying to support its chip maker. Rapid is 590 billion yen in subsidies. So that approval actually came in right about, if I'm not mistaken, right after, if not right before the markets opened in Tokyo. And
nearly $4 billion US, Amazing. Yeah, so that's lifting some of the chip stocks here in Japan. We're watching very closely what's going on with movers as well. It's earnings related. It's Xiaomi that's doing really the one that, whether they can deliver on the success of its new EV, SU7. The market seems to think that they can. We're up some 12%. I believe it was, who was, Xiaomi was one, Goldman? No. I forgot which bank it was. It basically said they can sell 100,000 cars by the end of this year.
So Goldman actually lifted a target on their sales potential.
That's the one.
On sales potential here. So just context to Yvonne's point there, the company said it received orders of nearly 90,000 units within 24 hours or so. And then Goldman Sachs came out and projected that orders might actually top 6 digits. There we go. Brilliance China is a similar story to Xiaomi, out with earnings, and then we went into this long weekend, so 30% effectively reflects still substantial the moves that we would have seen Good Friday and sort of Easter Monday here in Hong Kong. Fang Ke was the JP Morgan story, becoming the sole sell.
Full sell rating.
First one.
For the Hong Kong listed shares among the brokerages. So certainly that is another sign, a grim sign for the property developer after posting record profit declines.
And I think it's also the first time that the company decided not to give out a dividend since 1990. There's a nuance there. But certainly with a record drop in profits, of course, that's what effectively you're going to get.
Yep. Citi also with a catalyst watch for Trip.com as well. And we got dollars still very much in play here this morning. Weakness in the yen as well as renminbi. Plenty more ahead. This is Bloomberg.
Hello, Tokyo. Hello, everyone. Hello to everyone from Hong Kong that is in Tokyo. I know there's a lot of you right now, so you know who you are. What are you doing watching Bloomberg while you're on holiday? Don't be like us. There we go. We're going into the lunch break. 40,000, Nikkei 225. Dollar, we talked about this intervention watch. Is it 152 or is it the pace at which we get to 152? There's a sort of broader story, of course, on Terminal today on
It's
this.
interesting. Our economist, Taro Kimura, had a piece about what would trigger it first and foremost, and if it does, would it have a longer-term impact than previous interventions? And he says maybe because given the fact that the risks are a little bit more balanced around dollar-yen, and maybe even leaning more towards appreciation now, that maybe this time is a bit different. So maybe that intervention could be more successful if they actually do
more
it.
potent. I think, as Paul Jackson, who joined us earlier on, pointed out, anything less than a 4 yen move would be a waste of time and effort. So
we've been there before.
So 4 yen, that's perhaps a swing to watch. Okay, a couple of other things to tell you about. So we're coming out of a long weekend, and arguably so because of the holidays that are scattered throughout this week across Greater China. You know, a better part of this labor force is not back in the office, and perhaps going into, well, other things as well, right? So we're looking at casino shares, for example. Anyway, we'll talk about that later. I think we're looking at other stories, including travel-related stories. Sing Air, I think, had a good story today. They're resuming flights to several cities in China.
Oh, yeah. That's according to a CNA there. Some of the big corporate stories we're tracking is that one. In fact, Sing Air resuming flights to later on this month, those 3 cities that we just mentioned, following a 3-week suspension due to what it described as regulatory reasons. Now, CNA reports that services to Chongqing, Chengdu, and Xiamen will restart on April 22nd. Singapore Airlines has not elaborated on the reason for the suspension, but this is not the first time it's had to pause flights. Nippon Steel has made a formal commitment on spending and jobs to the United Steelworkers Union. The agreement includes an extra $1.4 billion in capital spending, as well as a promise of no layoffs before 2026. Nippon Steel's new president has pledged to press ahead with the takeover. That's despite opposition led by President Biden, who says U.S. Steel should be American-owned. Rakuten Group is said to be coming back to the high-yield bond market with a $1.25 billion offering. Sources say the Japanese tech firm will use the proceeds from 5-year bonds to buy back debt due later this year and beyond. Early pricing talks are reportedly for a yield in the mid-10% range. Citigroup is said to have implemented a fresh round of job cuts in its U.S. investment bank last week. Sources say technology, media, and telecom were among the coverage areas hit the hardest, with senior bankers in junior roles affected. The cut comes as Citigroup says it has concluded the major actions around its reorganization plan.
We talked about Macau, so here is how the house is winning. So there's a reopening play that's at play here. So there's a gap higher, broadly speaking, across Hong Kong markets. And then you have this incremental outperformance today in some of these names on the back of some data coming through. Macau March casino revenue beating estimates boosted by the holidays. So if you're looking for a number, gross gaming revenue up 53% from the prior year. $2.4 billion for the month of March. And of course, we're going into April and you have a holiday still this week. So we could see the continuing or seeping into, of course, the first few days of April as well. Let's get a sense of Macau. And broadly speaking, of course, we're also talking about
Kweichow
Moutai, which is coming out with earnings today. Jennifer Song covers both areas. She's with Morningstar, senior equity analyst there. Jennifer, good morning, and thanks for coming on the show. Why don't we start with Macau? Why not, since we talked about that as well.
Sure.
The data so far from December, where I think it was a 90% year-on-year jump, and then now we're in the 50s. Do you think the recovery is losing momentum, or are we just in the early stages of that recovery?
I think the recovery is already in the middle. Currently, the March data shows the recovery already achieved to 75.5% of 2019's level, which is quite on track. So we think the recovery is quite good.
Okay, what is the timeline for this recovery going to look like to you? I mean, when do you think the market really is going to come back, maybe back to more normal or even accelerated levels?
Yes, because the air capacity will growing gradually is quarter by quarter. So we expect the Macau's GTR recovery to be on quarter-to-quarter improvement through the year. And our full year expectation is about 85% of 2019's level, which is up from 63 in 2023.
Oh, okay. I was looking at the data, and it seems that a lot of these casino operators are investing a lot in non-gaming related revenue streams moving forward. What's your outlook for cost pressures this year as a lot of the casino operators start to realize that cost coming through?
Actually, for the non-gaming investment, that also helps for the revenue growth. So when we visit the casinos, they always told us, even they don't see the revenue goes up quite a lot, but with the higher non-gaming investment, they will see that on that day, particular, their EBITDA is very high because the non-gaming event that brings customer to their casinos. So that is good for the overall sector growth.
Yeah, and I'm just looking at the ratings that you have for these casino operators. I think they're mostly a buy, with the exception of MGM China, which is a hold, Jennifer. I'm just wondering, are Macau casinos still the best way to play the China recovery story in this market now?
I think so. Because Macau is continue to grow, is one of the best sector to capture the China's growth, especially for the China consumer sector. We see the travel-related sector that growing faster compared with overall consumption sentiment. So Macau will be one of the choice to capture that demand.
A final question, Jennifer, on Macau. So you mentioned this is still the way to go longer term. Do you think gambling revenue ever returns or surpasses the peak? Because the big difference now, as you would know, the VIP segment is, I wouldn't say completely disappeared, but certainly because of you don't have the infrastructure
or junkets
or the junkets to support the VIPs to come into Macau. Do you think Macau can ever be the same? Is my question.
Overall structure definitely not the same because the losing of the VIP segment. We see some of the VIP segment that just divergent to those premium mass segment. And also we see the mass segment grow very fast. So we still expect the overall industry GGR to return back to 2019's level, which is supported by the mass market, which has a huge market in mainland China.
Jennifer, I just want to switch gears with your other coverage, which is, of course, liquor, with Kweichow reporting later on today. I mean, we were just talking to our analyst, Ada Lee, about how resilient this company has been in the midst of this weaker consumption story in China. What are your expectations for this results?
Okay, actually, Kweichow Moutai has previously announced the preliminary result at the end of December last year. So we won't see any surprise of this result itself, but our focus will be on more guidance part, which is include 2024's growth guidance. And also, we will be more interested to know whether the company going to lift its dividend payout ratio and also the non-coal revenue, which probably go for the long term will be another growth driver. That part includes those ice cream, coffee, and chocolate, something like that.
Okay. Jennifer, do you think the stock is boring to cover? Sorry, the reason I ask you that is because the business is so consistent, quarter in, quarter out, year in, year out. And I'm just wondering, growth is there if they want it, but it doesn't seem to be, they don't come out with guidance of 30%. It's always in the teens, for example. I'm just wondering how you're thinking about this company from that perspective.
So I think Moutai still react as an indicator for the whole sector because analysts will look at the wholesale price of Moutai, which is the indicator of the whole sector's sentiment. So for example, currently the Moutai's ex-factory price and the wholesale price, that's quite weak actually. So we will know the sector is remain quite sluggish for Moutai. And for sure, not only Moutai, including other premium baijiu like Liang and Luzhou Laojiao. So their demand is more resilient compared with other baijiu segments. So that's the truth. So Moutai's growth is quite stable because demand is very robust and the capacity has very limited, so they can't grow very fast.
Jennifer, you mentioned a little bit about the breakdown among the segments. So it seems like premium is still doing well. What else are you seeing in terms of the mainstream, even some of these local sub-premium brands among China now?
Interesting, yeah.
Yeah. Actually, for the mainstream product, that grows quite decent because they benefit from like a travel requirement for the family reunion, something like that, and also supported by the premiumization of the whole sector. So the mass market focus Baijiu grows quite decently, but for the sub-premium Baijiu, that's more related to the overall economic situation, which is mainly used for the business activity or commercial, social, something like that. So the growth is still under pressure. That means the overall economy is still yet to recover.
Any final question? Any particular reason that you prefer Laojia over Moutai as your top pick for the sector?
Because Moutai has a capacity constraint to limit its growth, but for Luzhou Laojia, it has a higher growth potential for this company, and the quality for its product is good, and also the management is very capable, and also its distributors cooperation is very strong. So we see a stronger growth for Luzhou Laojia compared with Moutai.
Jennifer, we got to leave it there, but we covered a lot of bases there. Thank you, Jennifer Song, Senior Equity Analyst at Morningstar, everything from casinos to Moutai. Take a look when it comes to your Asia dashboard here this morning. Yeah, we're still seeing a decent equity rally. It's really largely been lifted by Hong Kong, though. You take a look at the rest of the region, still looking a little bit slow. But that catch-up story in the Hang Seng, we're up 2.5%, more than 400 points to the upside here this morning. And it's a mixed picture across sectors here. U.S. futures are still slightly on the back foot, in the back of that stronger ISM manufacturing data. The Bloomberg Dollar Index also catching a slight bid. Plenty more ahead. This is Bloomberg. Here's your China Brief this morning. A look at some of the stories making headlines in local Chinese papers and trending on social media. We have the China Securities Journal reporting that the pace of IPOs has been slowing since the start of the year, with as many as 80 companies terminating their listing plans. And the report says that there's partly due to the stricter access controls by authorities to prohibit excessive financing. Now, according to the official data, the first quarter had 55 fewer listings than the same period last year, but it's a very different picture if you look at the M&A space. The Shanghai Securities News is saying that A-share M&A and reorganization is gathering pace here with an efficiency boost due to, of course, the industrial integration. Now, it says more than 200 listed companies announced mergers and takeovers in the first quarter. Meanwhile, over on Weibo, they've been talking a little bit more about the Sichuan Trust, whose bankruptcy application has been approved by Chinese authorities, and the firm defaulted on billions of dollars in trust products nearly 4 years ago. Now, this does mark China's second instance since 2001 where we've seen a trust being wound down. And some reactions on Weibo include authorities should enhance regulation, they say. Look at how easy it is to borrow money now. There are just so many loopholes in the banking system. And another user is saying, besides those from the big four banks, don't trust any financial products right now, Dave.
Oh, yeah. Looks like maybe that person got burned buying some exotic index tracker. Anyway, that's for a different conversation. By the way, also making news in China here. So Netflix, this new science fiction bestseller, Chinese science fiction bestseller, 3 Body Problems. And a story by author Liu Cixin portrays a fictional past, present, and future where the Earth encounters a civilization from another world. The opening scenes of this adaptation on Netflix, of course, starts during China's Cultural Revolution, a bloody period that authorities often avoid discussing, and Bloomberg opinion columnist Karishma Vaswani thinks that the series shines a light, actually, on a more complex version of China. Karishma joins us right now to talk us through this. It's fairly clear to see why there's controversy around, particularly around, why they chose this to be the starting point. I guess the question is, did it have to be controversial?
You know what, David? I think it did have to be controversial in and of itself. I don't know whether you've watched the series yet. I watched it over the weekend with my husband. It's definitely something that, gets you thinking. And it's based on a series of books, of course, that were a huge success, not just in China, but around the world, amongst some very loyal fans. And I think it's really interesting the way the Netflix series decided to start with that scene from the Cultural Revolution. I don't want to give it away to people who've not watched it yet, but it is not for the faint-hearted, to say the least. And I think that the fact that there has been this controversy around it, you've got Chinese fans who are saying, well, why has Netflix made this such an Americanized, westernized version of the much-loved book? And then you've got global fans looking at this. For some, it's their very first experience of understanding this tale, this wild, strange world that the author has created that's come out of China, but doesn't look anything like the kind of China that Xi Jinping likes to portray to the world. And that in and of itself, David, I feel is such an achievement, because it really portrays, this idea that Xi Jinping may want to control so many areas of public life, but when it comes to your imagination, he really can't do that, can he?
And it's interesting, as you say, right? I mean, no spoilers, obviously. I haven't seen it yet, but you really do sell it, Krishma. You talk about how the show presents an alternative world. Why do you think that's important?
Yvonne, I think it is important because when we look at some of the fundamental issues between China and the U.S. today, it's always about geopolitics. It's always about, what's happening in the Taiwan Strait, what's happening in the South China Sea. How do we, resolve the issue of trade tariffs between these two superpower rivals? But through this series and through the book, there is a global conversation taking place. I mean, you just have to look at social media to see the kinds of opinions that are being reflected as a result of what people are watching online. I mean, I have to say that, this is not available in China, but people are watching it through VPNs, and around the world they're watching it on Netflix. And now you have this conversation taking place where it's not about Taiwan and it's not about the South China Sea, but it's about this fantastical world and this sci-fi mystery. And in a way, and perhaps this is a bit idealistic, but forgive me and indulge me a little, it allows audiences from all over the world to talk about the same thing. And ultimately, isn't that what we're all about? We love watching stuff that makes us go, wow, and it brings people together in a way that I don't think we've seen in quite a while.
Which is okay, let me build on that. That's a useful exercise, isn't it? When you have two audiences, and your point, Chinese and American audiences, discussing the same thing, but looking at that very same thing through different lenses. Is this bridging that gap, if you will?
Yeah, I mean, David, you've put it so beautifully. I couldn't have put it better myself. And I think that lens should be applied even further in other aspects of cultural film and literary life. There are a number of sci-fi books in China that could make it onto the silver screens, despite the fact that this genre has been so heavily regulated within China itself. It was just a few years ago, in fact, that Xi Jinping and the government there came out with guidelines as to how to portray the sci-fi world on Chinese screens, but also as an export. And it was very much about showcasing China's technological advancement. What I think is interesting about this particular series is it came before that period. And I think it is a way for audiences around the world to sort of relate to each other and realize they all like the same thing.
All right, I'm going to binge watch it now. You sold me, Karishma. All right,
Good,
thank
I'm
you so
glad.
much. You can read, of course.
You've got to tell me what you think.
Karishma's piece. I will. We'll come back. We'll get you on the show. We'll talk about it. You can check out Karishma's piece on the terminal and on our website. Bloomberg opinion columnist Karishma Vashmani there joining us out of Singapore. We got plenty more ahead. This is Bloomberg.
The RBA is set to switch to a new framework for the implementation of monetary policy. The Assistant Governor for Financial Markets, Christopher Kent, outlined these changes in a speech, in fact, at our Bloomberg office in Sydney. Now, earlier, he spoke to us about the outlook for the central bank's policy settings.
the board's made it clear it thinks the interest rate path that will best bring inflation down in a timely manner is uncertain. And so they've not wanted to rule anything in or out with regards to interest rate changes. We're in a better place than we had been. Inflation's come down a long way. It does look to be moderating, but the path, according to our forecasts, is a gradual moderation from here. Labour market pressures, they're easing. They're still tight, but they're easing, and that's because growth's slowing, and so that brings demand into a better balance with supply. So all those things are in place. Our central forecasts are sort of predicated on sort of further good things happening, including productivity growth, but there's a lot of uncertainties around that. And I think the key point is those are reasonably well balanced as best we can tell, and because of that, the path's uncertain. The next rate change, don't know if it's higher, don't know if it's going to be a lower interest rate.
When you talk about the inability to rule out shocks, right? How much of those risks do you worry about that might be external, that might be geopolitical, that might be election-driven, the policies of other countries? And how much of it are sort of domestic, maybe structural macroeconomic aspects that perhaps we haven't seen in the data sets yet?
I think it could be both. We just don't know. But I mean, as a small open economy, we're always subject to developments offshore. We've talked quite at length about what's happening in China. China's a major export market for us, and there are concerns there about their property sector and the problems that they're trying to deal with there. So that can have an impact on things like the demand for our key commodities like iron ore, and that can move our economy around. But equally, domestically, things can be moved by what people here in the Australian economy are doing, particularly households at the moment. How are they going to behave in the future? That will sort of be a key point for where the economy goes.
Christopher Kent there, Assistant Governor at the RBA, speaking to Heidi earlier on, and just taking a look at when it comes to some of the market moves that we're seeing. Yeah, it's really a lot due to earnings, which is Kweichow coming out a little bit later on. Not much movement there, but Treasury wine, this one came out just a few days ago with China removing those tariffs on Australian wine trade. So there you can have a glass of wine, or you can also chug some Moutai. When it comes to Xiaomi tech and the like here, Xiaomi continues to deliver here when it comes to this new EV model. Brilliance China also up 30%. I think it was a record move for the automaker as well. We're checking more markets coming up with Haz. This is Bloomberg.